Welcome to Market Meridian, where we analyze the drivers behind U.S. equity market performance, sector rotation, earnings resilience, liquidity conditions, and investor positioning. In this comprehensive report, we explore the historic rally in U.S. stocks, focusing on the technology sector's leadership, macro liquidity dynamics, earnings growth, valuation debates, and the impact of interest rate expectations. Over the past session, major indices reached fresh record highs, fueled by strong momentum, institutional inflows, and optimism around artificial intelligence, productivity growth, and corporate profitability. This rally is not just a short-term market blip, it represents a confluence of structural and cyclical factors that have aligned to create one of the most sustained upward trends in recent decades. To truly understand the strength of this market, we must dive deeper into each of these drivers, unpack their interconnections, and assess their durability in the months ahead. The U.S. equity market remains the global benchmark for risk assets, with the S&P 500, Nasdaq Composite, and Dow Jones Industrial Average capturing investor sentiment toward economic growth, corporate earnings, and monetary policy. The S&P 500, which tracks 500 of the largest publicly traded companies in the U.S., has surged more than 25% over the past 12 months, while the Nasdaq Composite, heavily weighted toward technology and growth stocks, has jumped over 35% in the same period. The Dow Jones Industrial Average, a narrower index of 30 blue-chip companies, has also posted impressive gains, crossing the 40,000 mark for the first time in history. These milestones are not just symbolic, they reflect a broader shift in investor confidence, driven by a combination of resilient economic data, better-than-expected earnings, easing inflation pressures, and expectations of a supportive Federal Reserve policy shift. Together, these forces have created a favorable backdrop for equity appreciation that has outpaced most global markets. To contextualize this rally, it's important to look back at the market environment of the past 2 years. In 2022, U.S. equities faced significant headwinds, with the Federal Reserve embarking on one of the most aggressive interest rate hiking cycles in decades to combat surging inflation. At the time, inflation had reached a 40-year high of 9.1%, forcing the Fed to raise its benchmark federal funds rate from near zero to a range of 5.25% to 5.50% by mid-2023. This sharp tightening of monetary policy led to a sell-off in both stocks and bonds, with the S&P 500 falling nearly 20% in 2022. However, as inflation began to moderate in late 2023 and early 2024, the market's tone shifted dramatically. Investors started pricing in the end of the hiking cycle and the potential for rate cuts, which breathed new life into equity markets, particularly growth stocks, which are more leadership, driven by massive investment in artificial intelligence, cloud computing, semiconductor manufacturing, and software innovation. This leadership is not confined to a handful of companies, it has rippled across the entire tech ecosystem, from large-cap giants to mid-cap and small-cap firms that support the broader industry. Large-cap technology companies, often referred to as the Magnificent Seven, which includes Apple, Microsoft, Alphabet, Amazon, Meta Platforms, Nvidia, and Tesla, have delivered exceptional revenue and earnings growth, supported by robust enterprise spending and consumer demand. These firms benefit from scale, network effects, and high barriers to entry, allowing them to maintain margins even in uncertain macro environments. For example, Microsoft's revenue grew 18% year-over-year in the most recent quarter, driven by strong demand for its Azure cloud services and AI-powered tools like Copilot. Similarly, Nvidia's revenue surged 262% year-over-year, fueled by skyrocketing demand for its advanced graphics processing units, GPUs, that power AI models and data centers. AI-related spending has emerged as a multi-year growth driver, with ripple effects across chipmakers, cloud providers, hardware manufacturers, and enterprise software firms. According to industry research firm Gartner, global AI spending is expected to reach $1.1 trillion by 2026, up from $450 billion in 2020, driven by both large enterprises and small to medium businesses, SMBs, as companies across all sectors seek to leverage AI to improve efficiency, reduce costs, and gain a competitive edge. For enterprises, AI is being used to automate repetitive tasks, enhance customer service through chatbots and virtual assistants, and analyze large datasets to uncover actionable insights. Semiconductor companies. After years of supply chain disruptions caused by the COVID-19 pandemic, chipmakers have finally been able to stabilize production and meet growing demand. TSMC, the world's largest contract chipmaker, recently announced plans to invest $100 billion over the next 3 years to expand its manufacturing capacity, particularly for advanced 3 nanometers and 2 nanometers chips. This expansion is critical to meeting the growing demand for AI chips, as well as chips used in electric vehicles, EVs, smartphones, and other consumer electronics. Additionally, many semiconductor companies have raised their capital expenditure, CapEx, budgets to invest in new technology and production facilities, which is expected to drive long-term growth. While sector valuations appear elevated relative to historical averages, growth rates justify premium pricing for many market participants. The Nasdaq Composite currently trades at a price-to-earnings, PE, ratio of around 35, well above its 10-year average of 25. Similarly, the S&P 500 technology sector trades at a P/E ratio of 32, compared to its 10-year average of 22. However, when looking at forward P/E ratios, which take into account expected future earnings, the valuations become more reasonable. The Nasdaq's forward P/E ratio is around 28, and the technology sector's forward P/E is 26, which is more in line with historical averages when considering the strong growth prospects of AI and other tech trends. For many investors, the premium valuation is justified by the sector's exceptional earnings growth, which is expected to continue at a double-digit rate over the next few years. However, concentration risk remains a concern, as a narrow group of large-cap stocks accounts for a disproportionate share of index gains. The Magnificent Seven currently make up more than 30% of the S&P 500's market capitalization, and their combined gains have accounted for nearly 60% of the index's returns over the past 12 months. This concentration means that the market's performance is heavily dependent on the performance of these few companies. If any of these firms were to miss earnings expectations, face regulatory scrutiny, or experience a slowdown in growth, it could have a significant impact on the broader market. Market Meridian closely monitors concentration metrics, such as the S&P 500's top 10 weight, to assess the risk of a market pullback if these large-cap stocks falter. Broadening market participation would increase the durability of the rally. Should strength extend beyond large-cap tech to financials, industrials, healthcare, and consumer sectors, the uptrend would become more resilient. A broad-based rally is typically a sign of a healthy market, as it indicates that investors are optimistic about the overall economy, not just a single sector. In recent weeks, there have been tentative signs of broadening participation, with financial stocks rising on expectations of lower interest rates, which boost net interest margins for banks, and industrial stocks gaining on strong manufacturing data. Healthcare stocks have also shown strength, driven by positive earnings from pharmaceutical and biotech companies, as well as increased demand for healthcare services. Sector rotation often occurs during mature bull markets, as investors seek value in lagging groups. After a period of outperformance by technology stocks, investors may begin to rotate into sectors that have underperformed, such as energy, utilities, or consumer staples, in search of better valuations and dividend yields. This rotation can help sustain the rally by spreading gains across more sectors. Market Meridian monitors breadth indicators closely to assess the rally sustainability. Key breadth indicators include the advanced decline line, which tracks the number of advancing stocks versus declining stocks, the percentage of stocks trading above their 50-day and 200-day moving averages, and the number of new highs versus new lows. Currently, these indicators show moderate breadth, with around 60% of S&P 500 stocks trading above their 50-day moving average and 55% trading above their 200-day moving average. While this is not as strong as during the early stages of the rally, it indicates that there is some breadth to the market beyond large-cap tech. Earnings fundamentals remain the backbone of equity performance. Corporate America has demonstrated significant margin stability and pricing power, even amid input cost fluctuations. In the most recent earnings season, more than 75% of S&P 500 companies reported earnings that beat analysts' expectations, which is well above the historical average of 65%. This strong earnings performance has been driven by a combination of cost-cutting measures, improved operational efficiency, and pricing power, allowing companies to pass on higher input costs to consumers without significantly impacting demand. For example, consumer staples companies have been able to raise prices to offset higher commodity costs, while technology companies have benefited from economies of scale and strong demand for their products and services. Better-than-expected earnings beats have supported multiple expansion and allowed markets to absorb relatively high valuations. Multiple expansion refers to an increase in the P/E ratio, which occurs when investors are willing to pay more for each dollar of earnings. When companies beat earnings expectations, investors become more optimistic about future growth, leading them to bid up stock prices even if earnings growth remains stable. This has been a key driver of the recent rally, as strong earnings beats have pushed P/E ratios higher, particularly for growth stocks. Looking forward, guidance will be critical. Upbeat forecasts can extend the rally, as they signal that companies expect strong growth to continue. Conversely, cautious commentary or downward revisions to earnings guidance may trigger consolidation, as investors reassess their growth expectations. To illustrate the importance of earnings, let's look at a few examples. Apple, the world's most valuable company, reported earnings per share, EPS, of $2.18 in the most recent quarter, beating analysts' expectations of $2.09. The company's revenue grew 5% year-over-year, driven by strong sales of iPhones and services. Apple also raised its dividend and announced a new share repurchase program, which further boosted investor confidence. Similarly, Amazon reported EPS of 98 cents, beating expectations of 82 cents, and revenue grew 13% year-over-year, driven by strong growth in its AWS cloud business and e-commerce segment. These strong earnings reports have helped propel the stock prices of these companies higher, contributing to the broader market rally. Liquidity conditions also heavily influence equity direction. Global liquidity expansion, driven by central bank policies and financial conditions, has supported risk asset appreciation. Liquidity refers to the ease with which assets can be bought or sold without significantly impacting their price, and it is a key driver of asset prices. When liquidity is abundant, investors have more capital to deploy into risk assets like stocks, which pushes prices higher. Conversely, when liquidity is tight, investors tend to sell risk assets and move into safer assets like bonds or cash, which pushes stock prices lower. In the U.S., the Federal Reserve's balance sheet remains elevated at around $8.5 trillion, even after the central bank began quantitative tightening, QT, in 2022. QT involves the Fed selling bonds from its balance sheet to reduce the money supply, but the pace of QT has been gradual, and the Fed has signaled that it may slow or pause QT later this year. Additionally, the Fed has provided liquidity to the banking system through its discount window and other facilities, which has helped stabilize financial markets. Outside the U.S., other central banks, including the European Central Bank, ECB, and the Bank of Japan, BOJ, have also maintained accommodative monetary policies, which has contributed to global liquidity expansion. As the Federal Reserve signals potential rate cuts, real yields ease, reducing the discount rate applied to future cash flows. Real yields are nominal yields minus inflation, and they are a key determinant of equity valuations. When real yields fall, the discount rate used to value future earnings and cash flows also falls, which increases the present value of those cash flows, making stocks more attractive relative to bonds. This mechanism lifts equity valuations, particularly for long-duration growth stocks, which have more of their cash flows projected far into the future. For example, technology stocks and AI-related stocks are typically long-duration assets, as their growth is expected to accelerate in the coming years. As real yields fall, these stocks become more valuable, which has been a key driver of their outperformance. The Federal Reserve's policy path remains the most significant macroeconomic variable. Markets have repeatedly adjusted rate cut expectations based on inflation data, job reports, and FOMC communication. Currently, markets are pricing in around 3 rate cuts in 2024, with the first cut expected in June. However, these expectations are subject to change based on incoming economic data. If inflation remains sticky above the Fed's 2% target, the central bank may delay or reduce the number of rate cuts, which could weigh on equity markets. Conversely, if inflation falls faster than expected, the Fed may cut rates more aggressively, which could boost stocks. A patient Fed may limit near-term upside but reduce the risk of future inflation resurgence. Fed Chair Jerome Powell has repeatedly emphasized that the central bank will be data-dependent in its policy decisions, meaning that it will not cut rates until it is confident that inflation is on a sustainable path to 2%. This patient approach is designed to avoid the mistake of cutting rates too early, which could cause inflation to rebound, similar to what happened in the 1970s. While a patient Fed may limit near-term gains in stocks, it could lead to a more sustainable rally in the long run, as it reduces the risk of a policy mistake. A more aggressive easing cycle could extend the rally but raise concerns about asset bubbles. If the Fed cuts rates more aggressively than expected, it could flood the market with liquidity, pushing asset prices higher and potentially creating bubbles in certain sectors, such as technology or real estate. Asset bubbles form when asset prices rise far beyond their intrinsic value, driven by speculative buying rather than fundamentals. While there is currently no clear evidence of a bubble in U.S. equities, the combination of high valuations and abundant liquidity has raised concerns among some investors. Market Meridian tracks every shift in Fed rhetoric to assess implications for equities, including speeches by Fed officials, FOMC meeting minutes, and economic projections. Technical conditions show strong upward momentum, with major indices trading above key moving averages. The 50-day and 200-day moving averages are widely watched technical indicators that help investors identify trends. When an index trades above its 50-day moving average, it is considered to be in a short-term uptrend. When it trades above its 200-day moving average, it is considered to be in a long-term uptrend. Currently, the S&P 500, Nasdaq Composite, and Dow Jones Industrial Average are all trading above their 50-day and 200-day moving averages, which is a bullish signal. Breakouts to record highs attract systematic and trend-following strategies, reinforcing gains. Systematic strategies, such as index funds, ETFs, and algorithmic trading, are designed to follow market trends, and they often increase their exposure to stocks when indices break out to new highs. Trend-following hedge funds also increase their long positions in stocks when momentum is strong, which helps push prices higher. This self-reinforcing cycle has been a key driver of the recent rally, as breakouts to new highs attract more buying pressure, which leads to further gains. However, overbought conditions regularly lead to pullbacks. Overbought conditions occur when a stock or index has risen too far too fast, and investors begin to take profits. The Relative Strength Index, RSI, is a widely used technical indicator that measures momentum on a scale of 0 to 100. An RSI above 70 indicates that an asset is overbought, while an RSI below 30 indicates that it is oversold. Currently, the Nasdaq Composite has an RSI of around 75, which is in overbought territory, while the S&P 500 has an RSI of around 70. These levels suggest that a short-term pullback is possible, as investors take profits after a period of strong gains. Healthy corrections allow markets to reset sentiment before resuming upward movement. A healthy correction is typically a pullback of 5% to 10% from recent highs, which helps to remove excess speculation and reset investor sentiment. These corrections are normal in bull markets and can actually strengthen the rally by shaking out weak hands, investors who are likely to sell at the first sign of trouble, and attracting new buyers at lower prices. Market Meridian views healthy corrections as a positive development, as they reduce the risk of a more severe downturn and allow the market to consolidate its gains. Risks to the rally include persistent inflation, a delayed Fed pivot, geopolitical escalation, earnings disappointments, and valuation compression. While these risks exist, none have yet gained enough traction to derail the uptrend. Let's examine each of these risks in more detail. Persistent inflation is perhaps the biggest risk, as it could force the Fed to keep interest rates higher for longer, which would weigh on equity valuations. If inflation remains above the Fed's 2% target, the central bank may delay rate cuts or even raise rates again, which could trigger a sell-off in stocks. A delayed Fed pivot, meaning the Fed waits longer than expected to cut rates, could also weigh on the market. Investors have priced in rate cuts in 2024, and if those cuts do not materialize, it could lead to a reassessment of valuations, particularly for growth stocks. Geopolitical escalation is another risk, as tensions between major global powers, such as the US and China, or Russia and Ukraine, could disrupt global supply chains, increase energy prices, and create market volatility. Earnings disappointments are also a risk, as if companies fail to meet earnings expectations or issue cautious guidance, it could lead to a sell-off in their stocks and drag down the broader market. Finally, valuation compression, where P/E ratios fall back to historical averages, could occur if growth slows or interest rates rise, which would reduce stock prices even if earnings remain stable. While these risks are significant, there are also factors that could mitigate them. For example, the U.S. economy has shown remarkable resilience, with GDP growth expected to be around 2.5% in 2024, which is above the long-term average. A strong economy supports corporate earnings and reduces the risk of a recession. Additionally, inflation has continued to moderate, with the core personal consumption expenditures, PCE, price index, the Fed's preferred inflation gauge, rising 2.8% year-over-year in the most recent month, down from a peak of 5.4% in 2022. This moderation in inflation increases the likelihood of Fed rate cuts later this year. Investors must balance optimism with risk management, maintaining diversified portfolios and avoiding excessive leverage. Diversification is key to managing risk, as it allows investors to spread their exposure across different sectors, asset classes, and geographies. By diversifying, investors can reduce the impact of a downturn in any single sector or asset class. Avoiding excessive leverage is also important, as leverage can amplify both gains and losses. During a bull market, it can be tempting to use leverage to increase returns, but this can be dangerous if the market pulls back. In summary, U.S. equities remain in a strong bull trend supported by earnings growth, tech innovation, favorable liquidity, and economic resilience. Leadership from large-cap technology has driven index performance, but broadening participation would improve long-term sustainability. The technology sector's dominance is justified by strong earnings growth and the multi-year AI boom, but investors must remain vigilant about concentration risk. Earnings fundamentals are strong, with most companies beating expectations, and liquidity conditions remain favorable as the Fed signals potential rate cuts. Technical conditions are bullish, but overbought levels suggest a short-term pullback is possible. Looking ahead, the key variables to watch are Fed policy, inflation data, earnings guidance, and market breadth. If the Fed follows through with rate cuts, inflation continues to moderate, earnings remain strong, and market participation broadens, the rally is likely to continue. However, if any of these variables deteriorate, such as persistent inflation or a delayed Fed pivot, the market could face headwinds. Market Meridian will continue providing real-time analysis to help navigate equity markets, tracking all of these variables and their impact on stock prices. Thank you for joining Market Meridian. For more equity market insights, keep watching our coverage. Whether you're a retail investor, institutional trader, or financial professional, Market Meridian is your trusted source for in-depth analysis of U.S. equities, sector dynamics, macroeconomic trends, and investor positioning. Stay tuned for our next report, where we will dive deeper into sector rotation and the outlook for lagging sectors in the current market environment.